Worldwide markets this week. 3 stocks with more cash and investments than market cap. FOMC MPC Chinese House Price Index. China says Nvidia has violated anti-monopoly laws. And Trump says scrap quarterly returns. I'm Simon Brown. This is Worldwide Markets, episode 648 for 17 September, and we are recording Tuesday lunchtime. Worldwide Markets, powered by Standard Bank Global Markets, Retail, and Shift, the global money app that puts travel, shopping, payments, and investments in the palm of your hand. Enjoy the cheapest forex rates anytime, anywhere. Shift, powered by Standard Bank. Thanks to Standard Bank. Thanks to Shift for sponsoring this. Let's kick off with that Chinese house price data. I've been tracking it for, a while now. And if we go back, so we got for the latest data point, gave us a minus 2.5%. This is year on year newly built house prices. And the problem is that you buy a house today and in a year's time, the house next door sells for 2.5% less. You're not very chuffed with that. This has been negative since May of 2022. There was a blip in May of 23 when it went up to 0.1, positive 0.1, and it's been as low as 5.9 if you go back to October last year. The trend is definitely, it certainly seems to have bottomed in October of last year. It is certainly moving in the right direction. I think this is, we know the whole tale of Evergrande, which eventually went into bankruptcy, and all the other housing companies in China, the challenges that they had, the importance for these for regional areas of China, because they could sell land to developers, get income into the municipalities, for want of a better phrase, and therefore have money to run their areas. So, in the one sense, this is bad. We kind of know this. We've seen consumption in China not doing great. GDP only just surviving. Significant price wars, although price wars to a degree in new homes, but more in electric vehicles. That's more about market share. However, the trend is in the right way. So if I look at this, I think there are two things that we can say. The Chinese consumer is not in a happy place. And I think secondly, we could say, I suppose much like the South African consumer, it is better than it was a year ago, which might not be saying a heck of a lot, but it is better than it was a year ago. I'm recording this Tuesday. We've got FOMC rate decision Wednesday evening. We've got MPC rate decision Thursday afternoon. Consensus is the US will cut on Wednesday. The question is how much? That seems to be 25%. But the market is now saying we're going to get 3 cuts this year. There's a September meeting, and then there is October and December, and the sense is that they will get cuts at each of those 3 meetings. And then it's pricing in 3 cuts for next year. I'm not sure about the next year, but America's back onto cuts. Now, the unemployment data certainly says let's be cutting. The inflation data certainly says let's not be cutting. And I'm not sure what growth is going to be like. So they're certainly in a tight spot. Trump, of course, is trying to reconfigure the FOMC. I wrote an article for Financial Mail that came out last week on how that FOMC works in terms of who gets to vote. There are regional feds. They get to rotating. Their chair rotates through 5 members, but New York always there. So New York and 4 other chairs, and then 7 from the actual Federal Reserve. They're appointed to 12-year terms, and then they can be, from there, you can get yourself a chair. Jerome Powell's term as chair ends in May next year. His term as a member of the Federal Reserve, and hence FOMC, ends in 2028. Powell tried to fire Lisa Cook. That hasn't happened. She will vote tomorrow. And by all accounts, what he claimed she had done is simply not true. Certainly, that's her story in the court proceeding documents that we've seen. And of course, he's just appointed one of his advisors, who weirdly is not quitting his position as advisor to the presidency, is taking a leave of absence. And senators put that through, and they will also be voting. We are getting cuts. And you know what? We might even get 0.5%. I think not, but stranger things have happened. So what's happening locally? Inflation was 3.5 for August. That leaves no escape. If the SARB MPC is now anchoring inflation at 3%, and we had 3.5, there is no space for a cut. But there are some economists out there who say we will get one. There are others, Johan Els, Old Mutual chief economist, who says no local cuts until 2027. I think at this point, SARB probably pauses. We'll see our inflation maybe get to 3.6, 3.7. We'll see it then start coming down. And if we've got the Fed cutting aggressively on the other side of the equation, I think the SARB might follow. If the Fed is cutting and we're not, that interest differential gets quite wide. We'll see money flowing into our market, which strengthens the rand, which is nice. But, who knows, maybe the SARB is typically worried about the other side of that equation where they're raising and we're not, and money flows out and then our rand weakens. But we will know all of this in the next couple of days. An interesting comment from Trump recently. SEC should require Securities Exchange Commission public companies to report results every 6 months instead of quarterly. Now, I look at this and I think, it's not a bad idea. Quarterly results, man, they hurt my head. And to be clear, the last thing I want in our local market is quarterly results. That's not something that particularly interests me at all. I think as it is, we have plenty of results coming, plenty enough. So I like that idea. His logic is it takes too much time and money. I'm not so convinced about that. I know there's a lot of folks who say, oh, the red tape of being listed and costs of being listed. Sure, but benefits of being listed, I think, in most cases, outweigh all of that. But then I was reading an email from Professor Galloway, Scott Galloway, that's his name. And he was saying, but hang on a second. Why is the American stock market the market of exceptionalism? And to be clear, it is. I mean, let's not mistake ourselves. It really, really is. And we can see that. And in fact, when I'm back from holiday, I'm going to talk around what has driven returns in the US. And it's not so much fundamentals. It has actually more been dollar and the increase in the PEs, in other words, the valuations. There's what I'm looking for. And that's around American exceptionalism in the market. And that's around, have they had Enrons and WorldComs? Yes, they have. But by and large, they, for the size, avoid big fraud disasters. And that, he says, is quarterly returns, and you don't want to do away with it. I don't think they're going to change it. I think it is in place. I don't see anyone having the brave enough to say, let's bend this. Absolutely, why not? I think thanks, but probably I think no thanks. So we've got some events coming up this Thursday, the 18th. Machine Magama is doing advanced charting for traders and investors. And then 16 October, I will be presenting on the Buffett Blueprint. Warren Buffett, of course, stepping down, retiring, end of the year. We know that from Berkshire Hathaway. The question is, what can we learn from him? He started life as a die-in-the-wool Benjamin Graham value investor. He shifted to be a Ken Fisher growth at reasonable price type of investor. There's a lot we can learn from his investment style, or of course we could just buy the Berkshire Hathaway shares. Both of them, 5:30. You can attend live in Rosebank in Johannesburg at the Standard Bank head office or webcast. JustOneLap.com/events for more information and booking. So the Caxton results came out on Friday, and I was taking a gander through them. And what struck me is they've got 3 billion cash, and they've got 4.4 billion market cap. And I thought, yowza. Now, let's to be clear, of that 3 billion cash, they've got a pref share dividend and a special dividend, a whole load of dividends to pay out, but it is still 3 billion. Now, they were a bit vague, 700 million, but there was 3 billion of cash and cash equivalent, as they call it. They have also shares in Impact worth 1.3 billion at the last number. So that's 4.3 billion. Market cap is 4.4 billion. And you got to say to yourself, that seems like quite the deal. You basically get Caxton for, let's say, for free. There are, as always, some T's and C's. And I think one of the key T's and C's is that why do they own those 34 point something percent of Caxton, and the logic there is of Impact, and the logic is that they are very clearly wanting to do a takeover, but there's a competition commission issue which they say has as of yet not been resolved, and until such time there is nothing that they can do. It is also a deeply illiquid share. It is not easy to build a position in this stock, but I mean, it was 5 years ago it was $3. It's now sitting at 12. This is the sort of company that if you build a position in, it's going to take you some time, and you really are a long-term shareholder. And it doesn't do much exciting. It traded through 9 Rand in March of 23, and then was still trading at sort of top end of 9 Rand in August of 23. I suppose that's 10%, but it's a slow little stock, and it's not going anywhere in a hurry. But there certainly is some assets here. So Caxton, those, if you live in a neighborhood somewhere, you get those weekly newspapers, that is Caxton. Is that dying? A lot less than paper than normal print is, simply because they run it purely on advertising. And I mean, I can remember, I occasionally get one where I am now, but the newspaper would be 8 pages. And the advert inserts would be 30 pages and the like. And it's the, 10 pages of Pick and Pay or Checkers or whoever sort of advertising. So they've got that business. But they're also moving into packaging and the like. That's what they're really interested in these days. And of course, that Impact stake, which pays them nice dividends. Forward PE, nope, nothing there. Current PE is around 7. Dividend yield is around 5%. Both of those are fairly attractive numbers. And the thing is with Caxton is that they are deal makers, and I forget the website. It was one of the property or auto websites, which they bought. They ran it for a while, and they sold it, and they made a couple of $100 million profit off it. So I don't think we're going to get special dividends from them by any stretch of imagination, but what we are going to more likely get is really good business deals. Now, the risk is, of course, they are really bad business deals. That is always the risk in that environment. But I got to say, Caxton looks really interesting. It's never going to shoot the lights out. It's never going to be the biggest stock in the world or do 100% in a year or something like that. But a nice dividend payer, a nice bit of return, and you've got what Buffett would refer to as a margin of safety. The margin of safety is, sell the Impact shares for 1.3 billion, take the 3 billion cash, and boom, that's pretty much your share right now. That is a margin of safety. The other one that popped up was Supergroup, and this one perhaps a little more T's and C's involved, but nonetheless. Supergroup, of course, recently sold off their division in Australia, SG Fleet, for which they got a vast amount of money, and for which they returned about 5 of the 8 billion to shareholders. So we can see a stock that rallied and then pulled back down. The thing with Supergroup, 5.2 billion cash. That's on a market cap of 4.6 billion. But, and this is a big but, 9.5 billion debt and liabilities directly associated with assets held for sale. In other words, yes, but the balance sheet is not quite as strong as the Caxton one is. What does Supergroup now do? Supply chain, dealership, fleet solutions, dealerships local and UK. The dealerships is about 50% of revenue, fleet solutions under 3%. At the operating profit, supply chains is about 58%, dealerships is about a quarter, and fleet solutions about 15%. There is an argument where you could make that says we've been seeing vehicle sales pick up, and we've been seeing the like of Motus, We Buy Cars, CMH, which I hold, have all been following suit. Supergroup has not. Now, again, back to a story where we've got lower interest rates, where we've got lower inflation, where we've got two-pot withdrawals all happening. People are patently buying more cars. The difference is, I don't know much about the UK market. What I do see in the media is that the UK is in a really tough space. So, I mean, whilst I really like the Caxton, the Supergroup, They didn't have that big debt and liability. They've got a whole bunch of hold for sale assets. When they sell those, of course, they'll get a lot more cash. And maybe they take their 5 odd billion cash and sell down some of their debt. And importantly, liabilities directly associated with assets held for sale. In other words, probably debt in the balance sheet. Does it go with the sale? We don't know. We will find out in time. The third one, and this is probably no surprise to anyone, the third one is Pick and Pay. Except when you draw the numbers, Pick and Pay gets a ton more interesting than I have to say I had really thought about. Pick and Pay is currently got 65.6% of Boxer. That works out at about 20 billion. I'm rounding numbers here, folks. They've got 5 billion of cash. They've got debt of a little over $1 billion, and they've got 2.8 billion deferred tax loss, which means their first 2.8 billion of profit they pay no tax on. Let's park the deferred tax aside. Let's take their Boxer, their cash, and their debt. We get to about 24 billion. We got market cap 20 billion. In other words, if you broke up Pick and Pay, you would get more than the 27 odd rand that the share is currently trading at. And that perhaps is the important point. The PE looks totally horrible. Forward PE is 70. Current PE is negative, so it's just not there. Are they going to make money financial year 2026? The expectation is no, but they will in 2027, and then, of course, 28 as well, and they will grow quite strongly. And if they can do 2 rand earnings, it puts them in 28, which is expectation. That puts them on a PE of around 13-ish. And if you compare to ShopRite of around 20, that's actually not so bad at all. Price targets on Pick and Pay, we've got 6 holds and only 1 strong buy. Average is 31.86, low is 28, high is 37. Pick and Pay is 26.48 at Monday's close. So I forget what day of the week we were sitting on. So of the 3, now a lot of folks will say, well, why don't you just go and buy Boxer? You could, but you're paying the premium for Boxer. With Pick and Pay, you get almost 2/3 of Boxer, and then you get tax-deferred losses and cash and everything else. And to be clear, a lot of that cash is going to be on closing stores. It's not cheap to end a lease, and then reopening new stores in new places. But it comes back to that margin of safety. And of the 3, I mean, Caxton has a massive margin of safety. Pick and Pay has, I would argue, a massive margin of safety. And remember, going forward, Pick and Pay needs some cash. Well, they take some Boxer shares and sell them. You know, I don't know, Pick and Pay needs a couple of billion rand, say 2 billion rand. They go and sell themselves 10% of the Boxer shares. Thank you very much for coming to the party. That almost just gives them kind of free float at some point. And I do think they will eventually probably get rid of the majority of those Boxer shares, probably take themselves under 50%, maybe eventually take themselves down to 0. We will see how that goes. But Caxton, Pick and Pay, looking good. Supergroup, Supergroup, we'll leave Supergroup for now. Anglo-American to buy Canadian Teck, Teck as in the company which does copper. And the question is, they're focusing on copper. They will now be 2/3 odd copper. And they do have some synergies. They've got some South American mines, which are kind of like neighbors, but run completely individually. Now you just put a long conveyor belt between them, and presto, you've now essentially got one mine. And it takes them up to about a $50 billion company. It means that takeovers are unlikely. They do have to move head office to Toronto, because interestingly, the Glencore tried to buy Teck, and there was a big thing in Canada about they stealing our companies. So Canada's now actually got laws around this. Of course, BHP tried to buy Anglo-American. My question, this deal is going to take a while to close. They're calling it a merger of equals. I'm not sure. Does BHP come back and make another offer for Anglo and say to Anglo shareholders, hang on, do you want to do this and go off to Canada? They'll still be primary listed in London. They'll have their secondary here. Maybe they'll go to Toronto. I think they'll probably have to list in Toronto as well. But head office and the like will now be in Canada. Does BHP come for what is a cleaner business? BHP, if you remember, wanted to get rid of some coal assets. That's progressing, but there's been some challenges there after a fire. Platinum is gone. Iron ore, they decided to keep, and no one wants De Beers. I mean, they're going to have to sell De Beers. In fact, they should give someone De Beers and a diamond a ring and say, just please, sir, take it off my hands. Last thing, China says Nvidia has violated anti-monopoly laws after conducting a preliminary probe. The preliminary probe by China, of course. And this is a deal from 2020. And I can't help thinking they've also accused Texas Instruments of dumping. There is talk flying around, not talk, Donald Trump has said as much, that the deal for the TikTok story expires, the extensions given by Trump expire on Wednesday. That is going to be extended, and there's conversations happening right now in Madrid between China and America, negotiators on trade. This is part of that. Trump is promising a phone call with Xi Jinping on Friday to resolve all of this. And maybe this is just kind of China kind of saying, kind of positioning that they might go soft in TikTok, but they're not soft at all, And also, the company that Nvidia bought in 2020, what do they call it? Where's my, sorry, I've lost it. Anti-monopoly laws, part of it is because of trade restrictions, which is not really Nvidia's fault, is it? Anyway, we will see how that plays out. For now, we will keep an eye on it. I still hold Nvidia. I am happy with that for now. Worldwide markets, powered by Standard Bank Global Markets, Retail, and Shift. The global money app that puts travel, shopping, payments, and investments in the palm of your hand. Enjoy the cheapest Forex rates anytime, anywhere. Shift, powered by Standard Bank. Thank you, Standard Bank. Thank you, Shift. Remember, Power Hour this Thursday and then another one on the 16th of October. Next week, I am on the beach, so I'm going to pre-record a Second Brain podcast to drop in. Just what is Second Brain, but then how do I use Second Brain? Quick highlight. The thing is that our brains are very good at making decisions. How should we navigate traffic? Should we buy this milk or that milk? Should we do a takeover here or a takeover there? All of those sort of things. Our brains are quite good at that. What are our brains really bad at? Remembering. Really, they are bad at remembering. That's why we have to have little tricks to remember stuff, etc. And the Second Brain tries to help us with that part and manage this deluge of information that we keep coming at us. But we'll leave it there for now. My name is Simon. I will be back next week and then really back the week after. And maybe I will see you at the Standard Bank head office on Thursday. Until then, as always, look after yourself. And if you can, look after somebody else as well. Cheers all.